There's a ton of bad information out there regarding how much money you should actually have saved at different points of your life. In this video, you will learn how much money you should have saved by the end of each decade you are alive. Don't miss the end, where you will find out how much money you will have when you retire if you follow this plan. Why should you even think about retirement planning? Well, it ensures you have enough to live comfortably when you're not working. People are living longer now, so your money needs to stretch further. And just relying on Social Security? Probably not enough. Starting early really is key. Let's break down what you can do at different ages to boost your retirement readiness. Whether you're just starting your career or you're closer to retiring, there's always steps to improve your financial future. If you're in your 20s, retirement seems far off, right? But here's the deal. Starting now can make a huge difference. Aim to save the equivalent of your annual salary by the time you hit 30. Start small, maybe with what your employer matches. Add a bit to an emergency fund. Keep a budget and try to keep your spending in check, even if your income goes up. Speaking of starting early, let's dive into some investment options that can really build up that retirement pot. Self-managed 401k plans, also known as solo or individual 401ks, offer more control over your investments compared to traditional employer-managed plans. You can choose from a wider range of options, including stocks, bonds, mutual funds, and real estate, one of my favorites. And to set one up, just select a plan with low fees and good investment options, complete the necessary paperwork, transfer funds, diversify your investments, and regularly monitor your portfolio to ensure it aligns with your retirement goals. Hey, and if you're new to the channel, smash that subscribe button. If you think you can save this much in your 20s, wait until how much money you can have put away by the time you are in your 30s. Your 30s are when you start to see the financial landscape a bit clearer. You might be thinking about buying a home or starting a family. Now's the time to really start saving seriously. Aim to have about 1 to 2 times your annual salary saved by 40. Keep up with your employer's 401k match. Bump up your savings rate. Look into IRAs and manage your debts. And protect what you've built with some solid insurance. Crucial. All right, let's keep this financial train moving. Next up, IRAs, or individual retirement accounts. IRAs are great for saving for retirement because they come with some nice tax advantages. With traditional IRAs, your contributions are pre-tax and they grow tax deferred. If you're covered by a workplace plan, they might even be tax deductible. Now, Roth IRAs are a bit different. You use after-tax money, but then you don't pay taxes on the growth or withdrawals during retirement. If you want to retire early, you cannot skip what needs to be done in your 40s. In your 40s, it's all about acceleration, baby. You want to be pushing to have 3 to 4 times your annual salary saved by 50. Now is the time to max out those retirement contributions, tackle any high interest debt, diversify your investments, and maybe even think about getting long-term care insurance. Real estate investment can also be a smart move for building wealth. Let's talk about how property can bolster your retirement savings. Real estate can significantly enhance your retirement savings, whether it's residential or commercial properties. Rental income can provide a steady stream of cash. Properties typically appreciate over time, offer tax benefits, and are a great hedge against inflation. Just remember, real estate also requires upfront capital and can be volatile, so do your homework. If you still want to be able to retire early, you cannot skip what needs to be done in your 50s. Your 50s are crucial for checking that you're on track for a comfortable retirement. Aim to have 6 to 7 times your annual salary saved by 60. This is a great time to max out on catch-up contributions if you're behind. Reassess your investments for the coming years, plan for upcoming healthcare costs, and consider downsizing to stretch your retirement savings further. Let's not forget about the stock market. Investing here can really help grow your retirement pot. The stock market is full of opportunities. Index funds and ETFs offer a way to invest in a broad market segment with lower fees. Dividend stocks can provide a regular income stream, and there's potential for capital appreciation too. All right, it's nearly showtime, and if you still want to be able to retire, you cannot skip what's needed to be done in your 60s. The home stretch. Your 60s are all about final preparations. By now, you should be looking to have 8 to 10 times your annual salary saved. It's time to finalize your retirement budget, decide the best time to start taking Social Security benefits, and review your estate plan. Make any last-minute tweaks to ensure you can enjoy your retirement years to the fullest. Before we wrap up, let's touch on some alternative investments that could add a little extra to your retirement savings. Looking beyond traditional stocks and bonds, cryptocurrencies and precious metals like gold and silver can diversify your portfolio and protect against inflation. Just remember, high returns often come with high risks, so balance your investments wisely. Knowing the signs that you might not be on track with your retirement planning is crucial for making timely adjustments. Keep an eye out for warning signs like low account balances, high levels of debt, and lack of investment diversification. These can all indicate that you might need to step up your savings game. And finally, understanding the challenges and risk factors that can impact your retirement savings will help you navigate them more effectively. Common retirement planning challenges include a lack of financial literacy, inconsistent savings habits, and relying too heavily on employer plans. Keep informed and proactive to manage these risks. Let's wrap up with a quick calculation to show just how much you could save for retirement by following these strategies. Estimate annual expenses. Include costs for housing, healthcare, travel, and lifestyle. Determine withdrawal rate. Aim to withdraw 4% to 5% of your savings annually. Account for inflation. Plan for a 2 to 3% annual increase in living costs. Include Social Security. Factor in expected benefits from Social Security. Project investment growth. Use a conservative growth rate for your investments. Now, let's switch over to an example calculation. Let's use up-to-date data to make our example more accurate and relatable. All right, let's go to a step-by-step calculation. Annual expenses. According to the recent data, the average annual spending for retirees age 65 and older is $52,141. Number 2, the withdrawal rate. Now, using a 4% withdrawal rate, come up with this equation, which is required savings equals annual expenses divided by withdrawal rate, or $52,141 divided by 0.04 gives you an approximate $1.3 million. Now, number 3, adjust for inflation and investment growth. Considering inflation and the need for cushion to account for market fluctuations, you should plan for higher savings. Using a conservative growth and inflation estimate, planning for $1.7 to $2 million would be prudent to ensure comfort and security in retirement. Yes, it would. All right, so number 4, include Social Security. The average Social Security benefits is approximately $1,827 per month, or about $22,000 annually. This benefit can significantly reduce the amount needed for personal savings. Let's look at the equation on that. That would be adjusted annual expenses is equal to your annual expenses minus your annual Social Security benefits. With the adjusted annual expenses plus a 4% withdrawal rate, that gives us the adjusted required savings, which equals $30,141 divided again by the 0.04, which is going to approximately equal $753,525, which is what would be needed. Now, if you want to increase that number, that's when we work on all the other strategies that I teach in other videos. How do we increase our revenue? How do we increase our savings? How do we make better decisions around money? To cover an average annual expense of $52,141, adjusting for Social Security, inflation, and a 4% withdrawal rate, aim to save between $1.3 million and $2 million for a comfortable retirement. As promised, by following these strategies and maximizing your savings potential, you could retire with not just over $1 million, but up to $5 million in savings. Now, how is that possible? Consider factors such as your annual expenses, a reasonable withdrawal rate, inflation, Social Security benefits, and investment growth to get a realistic picture of your retirement savings potential. By starting early, consistently increasing your savings rate, taking advantage of employer matches, diversifying your investments, and making informed financial decisions, you can significantly grow your wealth. Imagine the financial security and freedom that comes with such a robust nest egg. This level of savings can provide you with a luxurious and stress-free retirement, allowing you to enjoy life to the fullest. Thanks so much for watching, and I hope you found these tips helpful and are feeling more prepared to plan for your retirement. Drop your thoughts and any tips you have in the comments below, and I will catch you in the next video.